guys, we're back again with another video, and I'm almost positive this is going to be a big eye-opener for many of you. I will be going over SMT Divergence utilization. What is it? Why is it important? And I'll be using ES as a trade breakdown that I took for NFP for the start of April. Now, before getting into the charts, I want to tell you guys what actually SMT is. It stands for Smart Money Tool, and it is the cracking correlation between two assets at key highs and lows. And why is it important? It is important because it allows you to identify which pair is the strongest or the weakest. In a bullish market, you always want to be longing the stronger asset, and in a bearish market, you always want to be shorting the weaker asset. And I made a little diagram here in the bottom left. And if you look closely, the bottom we have sell side liquidity run at the low, and we have sell side liquidity here at the low on the bottom right. In a bullish market, what are we going to be doing? We're going to be prioritizing a long position on the stronger asset. And as you can see, the asset on the left failed to make the lower low, but the asset on the right made the lower low, taking out the sell side. If I'm in a bullish market, I am going to prioritize longs on the stronger asset, and vice versa for shorts on a weaker asset. If price takes out buy side liquidity on a stronger asset here, and we fail to take out the high on the correlated pair, I'm going to short the weaker one that failed to take out the high. Having this understanding of price and where we are in the markets will definitely keep you on the proper side when you're looking for these executions. Now, what I have here is the S&P, the NASDAQ, and the Dow Jones all with a daily chart. Now, look and see if you can identify what I was speaking about before in regards to SMT divergence. And keep in mind, this day is Friday NFP for the month of April. So before I show my annotations on the next slide, focus on the lows and focus on the highs and see if your annotations match mine. I probably could understand that you marked off the highs and you marked off the lows. So something to note here, we have the start of the week marking off with this vertical line and getting into Friday's daily candle. We have a Monday high of week across all assets. But if you look at the corresponding lows, we have a higher low on the ES and a higher low on the NASDAQ compared to YM, which is the weaker asset, taking out the lows corresponding. But if you also look at the highs here, what do you notice? I noticed that the S&P also made a higher high, but the NASDAQ made a lower high. Overall, there is more strength that I'm noticing on the daily chart out of the S&P compared to the NASDAQ and compared to the Dow. Right off the bat, my eyes are already paying attention closely to a potential position that I could set myself up with on the S&P compared to the other two. Now, utilizing time frame alignment, we're going to go from our daily to our 1 hour, and I want you to do the same thing. Mark up your corresponding lows on the Friday's trading day and see if it matches what I have mine on the next slide. I carried over my SMT at the lows on the daily with the YM showing the higher low on the ES and the NASDAQ, and I also added the daily dividers for that week of NFP for April. Now, if you look closely, you could check what happened on Friday's day when we had our NFP data release. We had the low run on NASDAQ making a lower low, and the ES on Friday making the higher low. We have more SMT divergence getting into Friday's daily candle. For me, I'm getting more and more and more confident that I want to set myself up in a position to go long on the S&P compared to the Dow and the NASDAQ. Given those factors, I'm going to get a closer look position on what the S&P and what the NASDAQ looked like together on the hourly chart for that Friday's day. Now, what I used here was the range set from Thursday. I measured out premium and discount, the impulse swing high to low, and used equilibrium as a draw on liquidity for price to push up to close out that weekly candle. And what we'll do here is we'll go from the hourly to the M5, and I want to walk you guys through exactly what I saw in my trade execution to go long on the S&P compared to the NASDAQ when price had NFP data release and equities open. Here's the closer look on the M5, seeing how we have the SMT at the lows with NASDAQ and we have the drop, the Judas swing that gave us from NFP, and then we have equities open. And just a little tip, whenever we are trading indices, it's always best to be waiting for after the 9:30 opening bell, because that is just a more so indication for engineering more liquidity, potentially creating more SMT, identifying which asset will truly be stronger to go into your draw on liquidity objective point. But as of right now, I know that the S&P is stronger, but I have no clear indication as to what we want to do yet. I have a bullish bias on the day, but I don't have anything to offer me on structure just yet. I want to wait for more clarity, maybe a shift in structure, clearing above this high here or this high on the NASDAQ for us to then move into our draw to the equilibrium of Thursday's range. And this is why it is important to wait for after equities open, because you can see what happened here. The NASDAQ ran the lows again after equities open, creating more SMT divergence with the S&P. We have higher low, higher low, higher low after the bell. And after that, we have price on both ES and NQ closing above this high, giving me an identification of a market structure shift. All of the cards are aligning for me to put myself in a position to go long on the S&P compared to NASDAQ because of all of the SMT divergence that it has shown me in the Kraken correlation, showing the strength out of this asset compared to this one. Now I know that I could focus my entirety on the S&P. I marked off the impulse low to the high that broke structure closing above the high, and I did premium and discount. Price came down on the M5, tagging discount of that M5 range, but you guys also know this, what I look for in my entries. I always look for a run on buy stops if I'm bullish and sell stops if I'm bearish. And I have this short-term low that was set in discount of the range. And if you guys also know this in the past, ICT has said this: if you can treat the hourly candle as a daily, a whole new world will open up to you. And that is what I did in this case for the 10 o'clock candle to form, framing myself in the wick below the open of continuing on price delivery. The next candle we had was a wick down, clearing out the buy stops at this short-term low. We now have a potential for an intermediate term low to form that was in discount of that M5 swing. I'm looking at this right now as an accumulation, manipulation, distribution, drawing to that equilibrium high. And if you know this, identifying high probability bullish order blocks, this down close candle that sweeps liquidity, and then when the next candle can close above that body high, that's an order block. And it's high probability as well because it swept out buy stops and then we had a closure above the body. So I could use that as a potential entry, and that is exactly what I was looking for. And you could see here the next candle closed above the body high, and then I wanted the next candle to give me a tag of that order block, which it did here. What I did was I had my entry at that order block and my stop loss was at the intermediate term low that I labeled here, the anticipation. And on top of that, we created more SMT divergence with NASDAQ. But you guys might also say, Matt, we made a lower low on the S&P. Why didn't you long NASDAQ? Because it made the higher low. The daily was telling me strength on the S&P, and the hourly was telling me strength on the S&P. And after equities open, I had more factors in lining myself up with the S&P compared to the NASDAQ. So this would still be my favor. And I knew that this was a protected low because of the SMT divergence running the buy stops. And like I said before, when you frame an hourly candle like a daily, we're buying below the open. We're framing an open low high close for a bullish strong liquidity, treating that hourly like a daily. I'm buying in the wick, and I'm expecting the candle body to distribute higher from here, leaving this as a protected low. And as clear and easy as I said it was, price delivered. This was a 1 to 2 risk to reward if I close it at 11 o'clock, and that is exactly what I did, leaving it at that. We distributed from that order block, but if you guys also know this and you wanted to hold the trade longer, an intermediate term low is not confirmed until we have a short term low to the right of it. And if you look in the next slide, price did create a short term low, retracing a little bit into the fair value gap, and then distributing finally to Thursday's range equilibrium draw and liquidity. This is exactly how I use SMT Divergence in all of my trades, and when that is not present, I do not take the trade because I have no identification of what asset is strong for a long or weak for a short. I promise you, if you back test this, forward test this, you will most definitely find yourself on the proper side of the market whenever you are looking to execute any sort of position. But I hope you guys all enjoyed the video, you learned something well, and I look forward to catching you guys in the next upload next week.